Hi everyone. A lot of people want to know what trading is about, and I thought I'll give you a simple explanation here. As a trader myself who went on from being a private investor to a hedge fund manager, I thought I'll give you an insight into what it involves and make it interesting for you. Okay, so what you can see on screen is the Dow. You'll have heard of it. It's the major US index, and you will see that across a period of time there are some arrows. Let's just look at this end at the far end over here where we are at the moment, okay? And trading is essentially about, obviously, buying low, selling high. What people don't often realize is, as well as buying low, which is at this green line here, and selling at a higher price, and I'll address the issue of how do you know when to buy and when to sell, because after all, we've only got two decisions to make, when to buy, when to sell. The other aspect of trading is we can also, and this is a key advantage, sell first, i.e. sell high, and buy low. Now, the advantage of that is this: if the markets are falling, you're able to make profits if you sell high and buy low. And also, it means that if they're going sideways, as you can see for a period of time here, you're still able to make profits from the intermittent rises and falls. Now, sometimes people say, well, wait a minute, don't you have to be a screen slave? Well, actually, no, because if you observe enough instruments, and I'm just focusing on the Dow here, but let's say you were looking at a group of instruments within a short space of time, you'd only really look to place one trade in a day. Now, some people say, no, you'd place hundreds, wouldn't you? Well, think about it. If you're placing hundreds, you are spreading your money thin. You're spending a lot of time in front of the computer screen. It's better to have a quality trade and more capital in it than a bunch of low quality trades with very little capital by definition in them and spending a lot of time in front of the screen, which is what that would entail. So what a lot of traders do is they will focus on not just their return on capital, but the return on time invested. Now, one other point I want to make, or several other points I want to make to you, is this type of trading where, like I said, all trading is about buying low, selling high, or selling high, buying low, is where we're looking for trends. And one of the most important critical factors of trading, which I write down in the acronym SELMA, S-E-L-M-M-A, which stands for stops, which is how do we know when to get out, and that's the stop loss. Now, some people might put that closer, some might put it further away. The critical factor is, if the market's more volatile, you want your stop loss to be further away. If it's less volatile, you want it to be closer in. To which you might ask, well, wait a minute, if my stop loss is further away because the market's more volatile, surely I'll lose more money. No, you would reduce your position size, or the money management aspect of SELMA, the M in SELMA, money management. You would reduce your position size accordingly. So you don't risk losing more money just because your stop loss is further away because the market was more volatile. By the way, as I continue, I should say, please hit subscribe, like, and all those things on these videos. Everything I'm teaching you, I have converted into videos from my book. So you don't have to buy the book. They're all going to be on videos on my YouTube channel. So follow the channel. The book was published by Financial Times. It's called Trading Online. It's an international bestseller. Like I said, don't buy the book because I'm converting it all into videos because people love videos instead. It'll cover everything from brokers to everything else. So let's get back into this. You've got your stop loss. You've got the entry and how we get that, the E in SELMA, in a second, I'll explain. This dotted line is where you would look to, if you're a more advanced trader, more experienced, add to your winning positions. Winners add to winners is a common saying amongst hedge fund managers. Losers add to losers is the opposite of that. So you don't want to add to your losing positions. If you're more advanced, you'll add to your winning positions. But you might ask, Alpesh, if you're not in front of the computer screen, then wait a minute, how do you know when to exit? Well, there's a couple of things. One is either you will be in front of the computer screen and whatever entry rules got you in will be the same rules which would get you out, because if they no longer apply, you'd exit. But let's say you don't plan to be in front of the screen and most people have got better things to do than look at these lines all day long. Then what would happen, and what you would do, is you'd simply instruct the broker, I'm buying at this price, just on your phone, and at the same time you press the buy instruction, you would have your stop loss there, and you would make that what's called a trailing stepped stop loss. In other words, as this price moves up to this dotted line, this stop loss will step in that step to there. It won't follow it point for point because that wouldn't give enough room, because don't forget the markets go up, down, and you want to give something some room to get to its eventual target and not be what's called stopped out by whipsaw or stopped out by market volatility. Okay, so stepped trailing stop loss is critical. The distance from the entry to the stop loss is the same as the distance from the entry to where we would add to our winning position. Now, you're only going to do that if you're at a more advanced stage. I'll do more videos on that in the future. For the moment, leave that to one side. Just assume you're going to have an entry and a trailing step stop loss. Okay, now you'll notice from this that the market's gone sideways for a while, and you can see why we've got in and out. But you might also notice that, well, actually, Alpesh, you didn't pick the market bottoms and the market tops. Actually, the best hedge fund managers in the world can't. We don't have crystal balls, right? It's as simple as that. Anybody who claims otherwise is absolutely lying. You'll also note there was a losing trade here. Yes, we don't only have winning trades. A coin is right 50-50. A hedge fund manager should be able to make money even if he's right 50-50, because the trades in which he loses money should be less than the ones in which he makes money. It's not about how often you're right, it's about how much money you make when you're right. Okay, and that's something which private investors often don't realize at all. They think it's all about having some secret holy grail to be right all the time. Now, I've used a common retail platform. These kind of platforms, softwares, are freely available for many brokers. Okay, so I'm not even going to name brokers because many of them offer all this live real-time data for free. The indications you see here, the red and green arrows and all this text you see, that's been created by us to make our trading easier for us. But all the software, you don't need to pay subscriptions to anybody ever. Do not pay software subscriptions, okay, for data or charting software. Do not fall for the old trick when somebody says to you, oh, I've got some secret formula, right? Unless they're a regulated hedge fund manager, they don't have a secret formula, all right? They're just trying to get you to charge us to pay a subscription fee. And you certainly shouldn't be looking at sitting in front of the screen all day long. What you should be doing to get a better return on your time invested is having more capital in fewer trades than little bits of capital in a lot of trades. And if the trade isn't worthy of your capital, you wouldn't do it. And always start off with a demo account and only ever with risk capital. Remember, 76% of people lose money trading online. Now, I could argue, well, that's because the other 24% have read my books or seen my videos. I'm going to build up everything that's in that book into free videos for you step by step by step. So do subscribe to the channel to learn more as we progress. And I'll go into more details on how do we know when to enter. Okay, how can I run through the steps of Selma? Stops, entries, limit or take profit orders. If you're an absolute beginner, you would use limit orders, but on the whole you wouldn't, because you'll never make money if you use limit orders and cap your profits. You need your profits to run away, not cap them. Okay, mind, which is trading psychology. Well, having a process will remove some of the fear and greed and uncertainty people have by having a set of rules. Money management, like I said, you make sure that if your stop loss is hit, you don't lose more than a small proportion of your overall portfolio. For a professional hedge fund, that might be as little as 0.5% of your total capital if your stop loss gets hit. And you can do some simple maths to work out, if that's where my stop is, if it gets hit, and I exit the trade at a loss, then how much would I lose as my overall capital? And A, which is adding to winners, which is more an advanced strategy, and it's actually the secret to successful hedge funds. It's the adding to winners part is probably the most important, as well as the volatility-based stop losses. 80% of your profits in a year will come from 20% of your trades. The 20% of trades it comes from will be the ones you will have added to your winners. And you say, well, why do you wait to add to the winners? Why don't you just put all the money in on day one? Because you'd be taking too much risk, and also you don't want to risk capital. You'd rather risk profits. When the price gets up to there, you're adding to the winning position. You're using some profits to make more, and should the position fall back, fine. You gave up some of your profits in order to get more, but it didn't work out. At least it was only profits that went and not the raw capital. Some of these principles, they are common amongst virtually every single hedge fund in the world. Okay, they're common. What's not common amongst all hedge funds is how they decide when to get in there. Obviously, they all want to get in, buy low and sell high. Some of them will get in maybe a little bit earlier, some a little bit later. Okay, that depends on their own little algorithms or processes or systems or whatever else. But the fact of the matter is none of them can escape, and neither can you, that buying low, selling high is what equals profits. Buy low, sell high equals profits. That's the truth in any business. And so when they get in and how they get in will depend on their own secret sauce. And we'll talk about that in future videos. Hope you enjoyed this one as a brief introduction to what trading is all about. Thank you very much.